I've showed you my dividend portfolio. It's right now 45% into REITs. And what I'm about to show you today is my trading portfolio in Tiger. Inside it, you see foreign shares, you see more cyclical stock picks, as well as speculative trades. So again, this is not investment advice, and what I'll actually lead with my next video is actually my net worth at the age of 40. So as always, smash the subscribe early, stay tuned for it when it's released. So in total for this trading portfolio in Tiger, you would see there's around 200,000 right now. I'll show you what's inside, my mistakes, my lucky breaks, as well as 2 key investment lessons right to the very end. So continue watching. Hi guys, welcome back. Without further ado, let's dive on to the ugly portions first. How about that? There are certainly losses for the year. Over here in this screenshot, you would see that 2/3 are profitable and 1/3 are losing trades. On a year basis, there are 36 stocks traded. Probably a bit too much, and I'm also trying to keep a tighter discipline. Top 5 losses, some of them I've covered on this channel, and no regrets on it because I've needed to trim positions to survive and stay afloat, but there's one glaring one that I'm not too proud of. I couldn't resist shorting Nasdaq. Can't remember when was that. And again, sometimes when I mention don't short the markets, it's also a kind reminder for myself. These are itchy finger trades which I'm also trying to eradicate. The better advice again is if markets look to be trending down, just accept it because Mr. Market is very fickle. One moment goes down, everybody is calling for doomsday, and next moment it could spring back up. That's why also I don't support all those option strategy of selling puts, because half the time you'll get right, half the time you'll get wrong. Hopefully when it's wrong, it's not catastrophic. So with the ugly portion out of the way, let's touch on the nice portion. Top 5 profits. Contributors. 2/3 of them are profitable, and the biggest contributors are as follows. Palantir Technologies, Centurion, Dynamac, LHN, and Franken. Palantir Technologies, something I've covered before in the previous episode. They have seen an uptick in share price because of inclusion to S&P 500, so that's a lucky break, not within my control. Centurion, I've noticed their growth in profitability, something I've shared on channel also. Dynamac, something I've also covered in the Telegram group. As always, if you're keen, look for links below to join. And what you can see is that the winners must always be bigger than the losses, correct? It shouldn't be the other way around, whereby you average down, just trying to catch a falling knife. You would realize that lost positions swell up very quickly. That is a bad habit that needs to be eradicated. The other thing also is when you have invested in something and it started to appreciate, the key part also is to hold on long enough. All 3 of them I've held on to a certain degree as they ran up in share price. So if you see in terms of the total profit and loss for 1 year, you would realize the yellow line is Nasdaq that has gained 38.42%, and the blue line is my portfolio at 47.06%. Pretty spectacular, but when we look back at the chart, it's quite obvious that there's something big in the last 1 month, correct? So what's the reason for it? If we see in terms of 1 month, top 5 profitable positions. Inside it again is Palantir, Tencent, Bengquang, Centurion, and LHN. So Palantir has continued to trend upwards in the last 1 month. Tencent has also very recently saw a big revival in share price. That is pulling up the profitability, and yet another lucky break. So when investing, sometimes there are bad times. Don't worry, there's always good times also to balance things up. So always stay optimistic. But the main thing is this, if we look in terms of 1 month, you can see that it's 100% win rate, correct? I want to caution against that also, because advertisements like to talk about winning profitability. When market is up, everybody looks like a genius. We need to stay humble also. But I'd like to point to some other parts that you may have noticed just now as key learning points before you embark on your own investment journey. The first question that I'd like to ask everybody, especially if you'd like to invest more into stocks, is this question: can you tolerate underperformance? I've learned this wisdom from Prof. Aswaf, and I'd like to play a clip for you.
You know what? You could have made 50 basis points more or 25 basis points more a year by investing in index fund instead of doing what you did, value companies and buy cheap companies. Are you okay with that? My answer is yes. I'm okay with not beating the market. I think it's critical because if you keep telling yourself, I did the right thing, therefore I should beat the market, therein lie the seeds for being righteous, for being indignant, for getting angry. I mean, when you get angry at markets, nothing good comes out of it.
What about my journey? Pulling up the chart again to see, the blue line being my portfolio and the yellow line being Nasdaq, you would realize that somewhere in March and April, it tanked quite badly, correct? Because I had a big position in Palantir. But more importantly, that is causing a massive underperformance relative to Nasdaq. Markets have been rallying, but my stock picks haven't. So it seems terrible. If I brought this up in June, people will be laughing at this. Why not buy Nasdaq? Why are you investing in stocks? So again, before you invest into stocks, ask this question. Would you be better off being diversified in an index, or even better, diversified broad-based? As I reflect back on this portfolio review, I'm leaning more to agreeing that most of us are better off not as stock investors, but broad-based equity investors. Stocks are good for me to do content because nobody would like to hear, including yourself, about diversified average investing 5 to 8%. You will fall asleep. I understand that. Stock picks up and down, very exciting. But again, investing is for your own retirement, for your own future. Leave the excitement for content like this. The second is stock picking is usually for passion. I like reading into books of companies and understanding businesses, and I think deep down sometimes it takes quite a lot of time also. And to this point, I'd like to introduce my upcoming Joshtan Finance Summit. And not just that, I have a further shout out to make. Last year we had a great successful event. This year, we're going to take learning to a new experience. Instead of a seminar room in SMU, we'll be going to a restaurant in Esplanade. I've booked it entirely for 50 of us. I'll be getting them to prepare great food, and we'll be discussing everything in person and taking a lot of pictures and live interviews. So if you're keen, let me invite you down to the new Joshtan Meet on 3rd of November 2024. This year, REITs will also be a key foundation team that we'll be discussing. So if you'd like to purchase tickets early, look for the links below. The second question before you invest more into stocks is, can you tolerate volatility? Famous investor Howard Marks has this saying, volatility can be a symptom of risk, but is not synonymous with it. Investors should focus on potential losses and how to mitigate them, not just fluctuations in prices. Today's content is very easy to do because I'm showing you charts, prices of movement, not deep diving into each and every stock, which is typically tedious and boring. But this wisdom by Howard Marks, let's look back at it. In the short term, market indeed is filled with potential losses. Let's pull up the chart again. If someone had just been broad-based, don't pick stocks, taking the yellow line, I've invested in Nasdaq, it's broad-based and a lot of people recommend it. But in these 2 months, you would realize that this investor would have also lost money, correct? Many times, new investors come on the markets and expect immediate gains. Once they don't see something in 2 months, they get frustrated and impatient. Or the other aspect which I've heard before is, I will only buy more investments if I see gains. That is not a right approach. Because if you're only waiting to see gains before putting more money to work, then you'll just keep buying all the way to the very top. You need to get used to investing when things are distressed, when things are coming down. That's actually when you get good value. The short term is filled with potential losses, but what about the long term? Actually, the market is always going up. That means also, in the long term, the market is not filled with potential losses. The right question to ask again should be, if I buy something that's overpriced but sound, it may take very long to make profitability. Nasdaq, after the dot-com bubble crash, took 10 years to recover back. So the question again is, 10 years, not too good, correct? So the solution again, as an investor today, if you don't want to wait too long, or especially when you need this investment pot to provide for your retirement, you can't wait 10 years, then you always need to diversify. It's not about chasing the best performing index, it's not about chasing the best individual stock performance. You need to diversify globally, US, emerging markets, a little bit in fixed income. All these need to come in. It's something I practice also when I build portfolios for private clients. The goal again when I run portfolios is to always be diversified. Again, in retirement, you need funds from your portfolio for expense consumption. You rather want predictability rather than the highest return of all investors out there. So as always, if you agree, smash the like button, and I'll draw this conclusion for all of us. Sound investing will always beat keeping monies in fixed deposit. I don't think it's correct when the question is being asked, hey, interest rates go up, I keep more as cash. Interest rates are coming down now, where should I start investing? I think it's a very backward looking approach, very reactive. I like this saying by Wayne Gretzky, a good hockey player plays where the puck is, But a great hockey player plays where the puck is going to be. Your money should always be looking for where are the assets for you to invest in that the world will still want tomorrow. Once you own enough of it and they produce cash flow, your retirement is secure. Play where the puck is going to be. Hopefully it resonates. And as always, a quick shout out again to my event, Joshtan Finance Summit 2024. We had a very successful event last year and I hope to see you there. And if you have missed my previous episode on my dividend portfolio, check it out right here. Thank you for watching and I'll see you in the next video. Take care as always. Goodbye.